Today I want to talk about the new designation and the training that I received for the CIAS. That's a Certified Investor Agent Specialist. It's from the same company that brought us the Certified Distressed Property Expert designation for short sales. So I really believe two of the quickest ways we're going to get out of the foreclosure problem is one, through short sales, stopping foreclosures, and two, investors purchasing up these cheap foreclosures, remodeling them, renting them, or reselling them. There's a lot of dilapidated homes out there in the market. As a lot of us know, just drive around Adrian, you'll see them. People need to buy those, and people need to fix them, or they need to be torn down. So let's talk about real estate wealth. Real estate and household wealth, $6.3 trillion of the household wealth in America is in home equity. It equals about 11.7% of the total wealth in America. So 42% of a family's assets are in real estate. Let's look at real estate versus other types of assets. Bonds and CDs, the 6-month CD over the last 10 years has averaged about 3%. It's not really a great investment. Bonds over the last 10 years have averaged about 4.35%. And these are stats from the Federal Reserve. Mutual funds often underperform the market. The average over the last 10 years has been about 3.66% from 2000 to 2010. Your mutual fund is managed by someone else, and the dividends are reinvested. You don't have any control over that. You do not get that paid out to you. Let's look at real estate over the last 40 years. A lot of people are talking, saying that real estate is a bad investment. I have the statistics here to show that it's not. Over the last 40 years, real estate has only seen 3 years of negative appreciation. 2006, 2007, and 2008. With the worst year, 2008, we lost 13%. So real estate is really a pretty solid investment if you look at the track history. This is the stock market over the last 40 years. S&P 500 has had 11 years of negative appreciation in the last 40. With the most, 2008 was also the same bad year for real estate. The stock market lost 38% that year. This is what the stock market looks like from 2000 to 2010. Obviously a lot of ups and downs, but over that 10-year period, there's a 30% decrease in the stock market. So let's look at the real estate market over that same period of time. The real estate market from 2000 to 2010 has actually gained 30%. Here's the bubble everyone knows about. Here's the crash, but we're on the way back up, and it's still actually ahead of where we were in 2000. So let's look at real estate versus stocks. If you invested $100,000 in the stock market in the year 2000, you would have lost $83,000 by 2010. If you would have taken that same $100,000, invested in the real estate market, you would have gained $77,000 of cash flow, and your $100,000 would now have a positive appreciation of about 107%. Let's look at the benefits of real estate. Real estate can provide cash flow if you have rental property. The tenant pays the rent, you deduct out your expenses, what's left over is your cash flow. You can use that money to invest in other types of investments or reinvest in real estate. Appreciation. As we saw, the average appreciation rate for real estate over the last 40 years has been 5% a year, but do not buy real estate as an investment to count on the appreciation. It's up and down, it's kind of unpredictable. It's mostly been up the last 40 years, but the best way to look at appreciation is to consider appreciation a bonus. You can create appreciation in a property. For example, if you're a rehab and resell investor, you purchase a property, you rehab it, you've created the appreciation in that property. So if you bought something for 20, you put money into it, you resold it for 60, you've created that appreciation by the improvements that you did to that property. This is median home prices since 1970. The dotted line here is the mathematical projection. The solid line is what actually happened for median home prices. As you can see, here's the big bubble on this graph. It literally is a bubble. Then obviously the crash, and this dotted line is where the experts project we're going. So as you can see, from 1970 till now, we're right back on track to where we should have been if you took this bubble out of the equation. Leverage. The good thing about real estate is you can use your money and leverage it through using other people's money through home loans. Other types of investments don't offer leveraged buying power. If you have $1,000 to spend on a stock or a mutual fund or a CD, that buys you $1,000 worth of that stock or mutual fund or CD. In real estate, if you have $1,000 to invest, that gives you about $5,000 worth of buying power. So for example, if you bought a $100,000 house with 20% down, you've only put down $20,000 and you have a $100,000 investment. Tax benefits. Let me put a disclaimer here. So you should always talk to your CPA before you purchase any real estate investments to see how these tax benefits will work for your specific situation. Whether you're a sole proprietor, LLC, or corporation, You need to talk to your CPA first before you do anything like this. But here's some basic information. Tax benefits, you can depreciate yearly deductions on improvements on the property. You can use a 1031 tax exchange to defer capital gains if you buy like-kind property and reinvest. There are other benefits, such as you can deduct these following items from rental property every year. And you can depreciate any improvements that you do to the property as tax deferred. So here's how depreciation works. If you purchase a property worth $100,000, $85,000 worth of that is attributed to the improvement or the house. You cannot depreciate the lot, you can only depreciate the actual structure. So at $85,000, the first year you calculate the first year's depreciation based on the month that you buy it, so you do not get a full year's depreciation that year. But every year after, for the next 27 and a half years that you own the property, you can deduct 3.636% from that $85,000 every year. So that equals, every year you can deduct $3,090 from that one rental property. So imagine if you had 5 of these, or 6 of these, or 10 of these, and you could deduct that much every year from each one. That would be a huge tax savings. I know people that own 30, 40, 50 properties and they barely pay any taxes because they can depreciate so much from all their investments. Leveraging your retirement. Most Americans have less than $25,000 in savings. You can use a self-directed IRA to purchase real estate and invest in real estate. The IRA grows tax deferred, and there's several different types that you can purchase. If you do not know if you have a self-directed IRA or not, you can talk to your financial planner and see if that's something that you're able to do. Real estate investing myth and reality. The myth, real estate investing is for wealthy people. That's not true. I do not have to be rich to invest in real estate. Most real estate investors made a median income of about $87,000. 39% of investors in 2010 made less than 75%, and 56% of investor households have dual income. Half of the investors are less than 45 years old. You do not need to be wealthy to purchase real estate investment. Real estate myth, real estate is too expensive. It's not true. The median investment property price in 2010 was $94,000. And again, these are national statistics. In our area, there's plenty of homes, $40,000 and $50,000 and $60,000 that are rent ready that you could purchase today. Another myth, real estate investments are mostly resort properties. That's not true. Only 7% are resort properties. Most investment properties are in rural, suburban, or small towns. So does that sound familiar? We have a lot of rental properties in our town that are available for purchase also. Most investment properties are within 20 miles of the investor's primary residence. That's just good sense. You don't want to buy something too far away. You want to be able to drive by it once in a while and make sure there's not no one's changing their oil in their front living room on their Harley or something. All right, optimizing your investment. So let's look at real estate as a tool for investing in college. So let's assume you purchased a $100,000 property. Let's also assume you did a 15-year mortgage on it at 5.5% interest and you put 20% down. Your payment annually would be about $7,800, and we're going to assume that it's going to appreciate about 5% a year, which has been the average for the last 40. So years 1 through 15, your cash flow is about $2,600 a year because you have a mortgage payment on it. When you hit up to year 16, that mortgage is paid off, so now your cash flow is up to $10,500 a year. And also look at this next column here. This is where it started. Add 5% a year for 17 years until your child's ready to go to college. That property is now worth $229,000. It's paid for, and you've also realized $60,000 in cash flow in that time. This $60,000 is just assuming you only put that in a savings account and saved it. You could use that $60,000, that cash flow every year, and you could put that into a college fund or a 529 plan or something like that, and that would grow a lot more than $60,000. Building real estate wealth with the 5x5 model. The 5x5 model is a simple model showing the potential growth real estate offers if you re-leverage the property every 5 years using a 1031 tax exchange to defer the capital gains. Basically what you do is you start out buying a $100,000 property, you put 25% down. So when you start, your 25% investment is literally $25,000. By year 5, that property appreciates 5% in a year for 5 years. Now your 25% investment is now $52,000, and you can reinvest that into a $200,000 property. 5 years later, another 5 years of 5% appreciation. Your initial $25,000 is now worth $110,000. You re-leverage that through a 1031 tax exchange into a $440,000 property. This is only by year 10. So obviously when we get to year 25 and 30, we're looking at $1 million properties. We don't have a lot of those in our community, but you could use this to buy several different investment properties. As long as you're using your 1031 tax exchange to buy like property, it's still tax deferred. Here's the 5x5 model. When you compare that over the 30 years to a mutual fund, if you started out with $25,000, did the 5x5 plan every year, reinvesting that money to buy bigger properties, you would end up with about $2 million from your $25,000 initial investment. If you did that in a mutual fund and left it alone for 30 years, your $25,000 would be about $400,000, which is still a lot of money. And is, but if you did that same thing with real estate and you did it well and correctly, you would have about $2 million from $25,000 over 30 years.